Hello everyone, I'm Namrata Arora and welcome back to another episode of Basics of Mutual Fund series that we've created for you. In the previous video, we spoke about the charges and the taxes applicable in the case of mutual funds. In today's video, we are going to talk about the systematic transactions or the systematic options that are available for an investor while investing in mutual funds. So systematic investment plans or SIPs are generally synonymous with mutual funds. A lot of investors who may not have invested in mutual funds also would have definitely heard of the word SIPs or systematic investment plans. It is considered to be a magic wand to create money or to get more money. So in today's video, it's an attempt to really talk about the different systematic options that are available under mutual funds, because systematic investment plans are not the only systematic options available. So today we're going to deep dive into all these systematic options how you can make effective use of them to really meet your objective. So let's get started. So in this video, we're going to use multiple examples and illustrations where we're going to take examples of different funds. Please don't take those funds as recommendation or advice, and we're just using them to show a particular concept to you. So when we talk about SIPs or systematic investment plans, SIPs are nothing but a method or a way of investing in mutual funds where an investor invests pre-decided amount of money on a prefixed date, which could be monthly or any other frequency option which is offered by the mutual fund, into a specific mutual fund. SIPs are one of the best ways of entering a mutual fund for an investor because they bring in a lot of discipline for the investor. Now, for an investor who's looking at achieving financial goals, SIPs can really help because you're going to invest small amounts of money at regular intervals, which will eventually lead to a corpus that is going to help you achieve that particular financial goal. From a flexibility and liquidity point of view, SIPs provide multiple benefits that we're going to discuss. SIPs can only be invested in open-ended funds where an investor can take out the money or add more money into the funds at any point in time. Now, the tenor for an SIP is also flexible, which means that you can stop. Just because there's a tenor which is pre-decided, it doesn't mean that you cannot stop the SIP at any point in time. You can stop the SIP anytime, and you can also continue to invest after the tenor by placing a request with the mutual fund company. Also, the SIP amount can be increased or decreased at any point in time. Even in terms of withdrawal, partial or complete withdrawal is possible in SIPs even before or after the tenor of the SIP. Now, just because SIPs are flexible, it doesn't mean that your time horizon or investment horizon for an SIP should be shorter. To get maximum benefit of SIPs, the investment horizon for an investor should be long-term, because in the long term, you have better chances of creating that wealth for yourself. So when we read up about SIPs or when we hear about SIPs, there's a very common term that comes up, which is rupee cost averaging. So let's see what exactly is rupee cost averaging. Every common man understands that while buying a commodity, we buy when the prices are low and we sell when the prices are high. But the problem is that with equity, we tend to do the exact opposite. There's a very wonderful saying which says that what we have learned from history is that we don't learn from history. So how do we do this? The problem is that there are certain factors which are not in our hands. So for example, markets going up and down, crude oil price, inflation going up, geopolitical tensions, these are not in our hands and they are uncontrollable factors. So what is in our hands? It's in our hands to invest regularly, select good set of funds and stay invested for long term to create that wealth for ourselves. Let's say you are an investor who's investing into a mutual fund through SIPs on a monthly basis. Now you would end up buying units, the mutual fund units, at different prices every month. This is because the market price per unit, or the NAV as we call it, would move in line with the market. So this eliminates the whole process of timing the market, which means as an investor, you don't need to worry about the right time to enter or the right time to sell in a particular mutual fund. Now, what this also does is it removes this whole behavioral quotient from the decision-making process, because you have set the purchase date for your SIPs. So let's understand rupee cost averaging with an example. So this is an illustration of an individual or an investor who's investing 5,000 rupees through an SIP every month. So let's assume that in the first 3 months of his investment into this particular SIP, the NAV has gone down. Now, every time the NAV goes down, it means that the investor is getting more units in hand. In the next 2 months, when the NAV goes up, the investor gets lesser number of units. Now, so over the span of 5 months, the investor has got a total of 1,392 units. And of course, the investment amount is 25,000 rupees. Now, the average price per unit is 17.96 rupees. So which means when the NAV of this fund is 25 rupees, the investor is already in gains. The whole idea of investing in SIPs is that when the markets are correcting, the investor would land up getting more number of units, and when the price or the NAV goes up, the investor would be in profits. The whole purpose should be to invest in SIPs regularly and to accumulate more number of units. So now we're going to take a real life example to show you the wealth creation journey that is possible through SIPs. Now, the example that we've taken is that of Nippon India Growth Fund. Now, this is a mid-cap fund which was launched in India in October 1995. And this fund has seen a phenomenal journey. The NAV of this fund as of 1st of Feb 2022 was 2,073 rupees. Now, for the sake of illustration, let's assume that you did an SIP of 10,000 rupees in this particular fund. Now, every time the NAV would go up, you would get lesser number of units, but every time the NAV is down, you would get more number of units. So had you done an SIP of 10,000 rupees on a monthly basis in this particular fund, and had you started this SIP in October 1995, just imagine the kind of wealth that you would have created for yourself. As of 1st of Feb 2022, the value of your portfolio would have been 13.18 crores. Now, this is only possible when you stay on in an SIP and stay invested for long term. So now that we've learned about systematic investment plans, we're going to now talk about another form of systematic option which is available under mutual funds, which is called Systematic Transfer Plan or STP. So let me just give you an example. Now suppose you want to enter a particular highway, and let's assume it's a 6-lane highway and you are entering from the bypass route. Now, when you're entering the highway, would you enter at the top speed and would you immediately shift from the left lane to the right lane? Obviously not. That's going to be fatal. So what are you going to do? You're going to enter the highway slowly on the left hand side, and then you're going to look for ongoing traffic, and then you're going to slowly transfer or shift from left lane to the right lane by looking at the oncoming traffic and by being very observant and careful. Now, similarly, this is a kind of risk we could also face in equity markets if you've invested through lump sum investments. Now, suppose you've done a lump sum investment and you fear that what if market crashes tomorrow and you're losing out on that opportunity of investing at a time when the markets are low. Now, to avoid that risk, you can enter equity markets in a phased manner through something called a Systematic Transfer Plan or STP. So what happens in a systematic transfer plan is that suppose you've decided to invest the entire amount in a particular equity fund. First, what you would do is you would invest that whole amount into a liquid fund. And then from that liquid fund, you would gradually transfer the amount into that equity fund that you have decided. And the frequency could be weekly, monthly, or any frequency that you decide. So for example, you want to invest say 1 lakh rupees into HDFC Flexi Cap funds, but you fear that the markets are going to fall in the coming days. So what you can do is you can invest the 1 lakh rupees in HDFC liquid fund, and then you could say that every month I would transfer 10,000 rupees from the HDFC liquid fund into HDFC Flexi Cap fund. So even if the markets were to fall in the coming days, you would not have invested the entire amount into equity. And also, if the markets were to fall, you would actually be getting your NAVs, or you would actually be getting more units every time the market falls. Of course, the flip side is also true. If the markets were to go up, you would miss out on the upside opportunity as well. So basically, a systematic transfer plan is nothing but transferring your funds from one fund to another fund to make use of the market volatility. So now I'm going to explain this through another example. Now, all of us have heard of the global financial crisis of 2008. Now, that was the time when markets corrected by almost 60% in that 1 year. So here, what we're going to look at is, if you're this particular fund, the example that I'm going to take, the NAV of this fund on 1st of Jan 2008 was 224, and the NAV on 1st of December 2008 was 99. So for the sake of illustration, we are going to take two different examples. First example, where we're going to invest a particular amount, which is 1 lakh rupees as a lump sum on 1st of Jan 2008. And we're going to see the value of the portfolio as of 18th of Feb 2022, which means you'd invested for almost 14 years, what would have been the value. And next example, we're going to see, had you invested the same 1 lakh rupees on 1st of December 2008, what would have happened? And would STP have helped us in this particular scenario? So let's take an example where you've invested 1 lakh rupees in this particular fund on 1st of Jan 2008. Now, as of 18th of Feb 2022, the 1 lakh value would have been about 4.43 lakhs with a CAGR of approximately 11%. Now, let's see if you had invested the same 1 lakh rupees on 1st of December 2008. Then as of 18th of Feb 2022, the value of your portfolio or that 1 lakh would have been about 9.98 lakhs with a CAGR of approximately 19%. Now, looking back and saying, it makes sense, but then how would we have guessed the market bottom at that particular point in time? So in this case, had we followed the STP strategy, then what would have happened? So had you invested in a liquid fund on 1st of Jan 2008, and had you systematically transferred into this particular fund over 10 months, 10,000 rupees every month over 10 months, then the value of your portfolio or the value of this 1 lakh as of 18th of Feb 2022 would have been approximately 6 lakhs with a CAGR of 14%. So using the STP route while entering the equity market really helps you in managing the risk of entering the equity markets. So now let's go back to the highway example that we had discussed at the beginning while we started discussing about STP. So let's assume that now you are on the highway and you're driving at a reasonably good speed and you're on the right lane. Now your exit is nearing and you have to, exit from the left side. So are you going to take an immediate left? Now that again could be very dangerous. So what are you going to do? You're going to first shift from the right lane to the middle lane. Then you're going to slow down and shift from the middle lane to the left lane and then take a smooth exit to your destination. Similarly, as the same example continues, suppose you are nearing your financial goals, say your child's higher education or say your retirement, and you've been accumulating corpus for so many years through your mutual fund investments. And now this is the year when you have to take out all your money because you've reached your financial goal. And let's assume that the markets crash by 40 to 50%. So imagine you gave so much time for your investments to grow, but your wealth just got eroded in no time because of the market crash. So to avoid such risk, what you should ideally do is that 1 or 2 years before actually achieving your financial goal, you should gradually start shifting your funds from equity funds to a debt fund or a liquid fund. How this would help is that even if a market crash happens in a particular year that you are achieving your financial goal, you have probably shifted out most of your wealth from your equity funds to your liquid funds and avoided the market crash and maintained your wealth. So now after talking about systematic investment plans and systematic transfer plans, now we're going to talk about the third and the last systematic option, which is systematic withdrawal plan or SWP. Now think of a retired investor who's looking to generate, who's looking to manage his or her monthly expenses through the regular income which is generated through the investment options. Now the traditional options which most investors go for are fixed deposits and say post office monthly schemes. The biggest challenge with these options is the low interest rate that is offered by them. The interest rate is on the lower side because of which it does not beat inflation, and for a lot of investors who have limited corpus, if they've invested in these traditional products, their corpus might just become zero in their lifetime and then they would have no way of managing their retirement. So how can they manage this risk, and what is it that a retired investor can do to really look at investments which can beat inflation? So one way of managing this is by investing in hybrid funds. So you could look at investing in a balanced advantage fund or an aggressive hybrid fund where say your investment horizon is say for 15 to 20 years. So what you could do is you could invest in one of these funds, stay on for say 2 years, which means don't withdraw money for the next 2 to 3 years, and then start the withdrawal process through systematic withdrawal plan or SWP. So let's first see how exactly a systematic withdrawal plan works. So say if you have your investment corpus in a particular mutual fund and you have decided the exact amount that you need every month. So you've decided a date, you've decided the amount. So on that prefixed date that you have decided, the mutual fund company is going to transfer that particular prefixed amount from your investment corpus or from your mutual fund into your bank account. So now let's understand such a systematic withdrawal plan or SWP through an example. So we take an example of a retired investor who has a retirement corpus of say 30 lakhs with him. and he's looking at his managing his expenses of 30,000 rupees every month through this corpus. His expenses are going to increase by 6% every year because of inflation. So now what this investor does is that he invests this 30 lakh rupees, which is his retirement corpus, into ICICI Prudential Equity and Debt Fund, which is an aggressive hybrid fund, and he invests this money on the 1st of Jan 2012. Now for the next 2 years, the investor is not going to redeem any money from this particular fund, and let's assume that he's already figured out how to manage his expenses for those 2 years. Now from 1st of Jan 2014, the investor starts the SWP from this particular fund. So what is going to happen is that from 1st Jan 2014, on the 1st of every month, 30,000 rupees is going to be transferred from the particular mutual fund to his bank account for him to manage his expenses, and proportional number of units are going to be withdrawn from that particular fund. So now let's see that this particular corpus that he's invested in this fund, what does it look like over multiple years? By looking at the chart, if you see the end result, the withdrawals, which was 30,000 rupees every month in 2014, was about 48,000 rupees in the year 2022 after adjusting for inflation. The value of his corpus at the end of Feb 2022 was about 87.65 lakhs. So what this fund has effectively done is that it has not only helped the investor with regular withdrawals, but it has also helped in capital appreciation. Now, there could have been a scenario where in the first 2 years of investment between 2012 and 2014, it's possible that maybe the fund had not appreciated, but probably had gone down because of maybe a market crash. Then what would have happened? Because since this is an aggressive hybrid fund and 70% of the portfolio is invested in equity, again, these funds should be held for long term. Even if you see losses in the portfolio, if you continue to hold it for long term, you will start seeing the fund performing. Apart from helping you with regular withdrawals, SWP also works as a very efficient tax management tool. So as per our example, where the investor is withdrawing 48,000 rupees every month, not the whole amount is treated as coming from the gains or coming from the principal. It is treated as part of it coming from the gains and part of it coming from the principal. And since there is a 1 lakh exemption on long-term capital gains, the investor would land up paying zero or very minimal tax in this particular case. Whereas had the investor invested in, say, fixed income products like fixed deposits and the likes, the investor would have to pay tax on the complete interest that he would have earned. So to sum up what we've discussed so far, systematic investment plans help you in bringing regularity, discipline to your investments and helping you build that corpus in the long term. Systematic transfer plans help you in managing your entry and exit into the equity markets by actively switching funds from, say, liquid funds to equity funds at the time of entry, or say from equity funds to liquid funds at the time of exit. On the other hand, systematic withdrawal plans can, from a hybrid fund can really help you in managing your monthly expenses and beating inflation in the long term, and at the same time bringing in the tax efficiency. So, invest through these systematic options. They help you in multiple ways and help you in bringing efficiency to the portfolio, optimizing your returns and reducing the risk. So use these systematic options to efficiently handle your portfolio, optimize your returns and reduce your risk. I hope you've liked this video. In the last video, we're going to cover the last topic in this particular series, which is how to pick mutual funds. So if you, of course, like this video, please do like it, share it with your friends. Of course, subscribe to the Groww channel. And if there's any other topic you want us to cover, please mention it in the comment section. And like I mentioned earlier, we have used multiple examples in this video to explain the concept, but then again, don't take that as our advice or as our recommendation. Thank you so much for watching.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and/or other instruments traded on the stock exchanges.